Good morning, everybody, and welcome to our webinar. Today, we're going to be discussing the post-COVID pre-cop26 MOT for liability-driven portfolios. Today's event is structured around some key themes and questions around our topic, and we're encouraging you to put your questions through, and we'll try and deal with them sort of almost in real time, almost like we're meeting in person. So do drop them in the chat. We'll pick them up as we go through, and we'll probably have a bit of time at the end to do so too. So I'm delighted to be joined today by our sponsors from the Pensions Insurance Corporation, and I'm going to hand over to Rob, who's going to do a brief intro to the team and a bit of background on PIC, and then we'll launch into our discussion. So over to you, Rob.
Good morning, everyone. My name's Rob Groves, and I'm Pension Insurance Corporation's Chief Investment Officer. Delighted to be here today, and I'm joined by two colleagues, Mark Gull, who's our Head of Credit and has been with us for many years, and Mark's prior to joining PIC many years ago, he managed credit portfolios for many years. Also joined by Cleo Fitzsimmons, who's our Head of Responsible Investing, and joined us last year from Schroders and has been doing some excellent work leading our efforts in that area. So I just want to spend 2 minutes talking about PIC, so you know kind of who we are and what we do, and you can see the slide in front of you. So the key point about PIC is we're entirely focused on the bulk annuity market in the UK. So we're a specialist insurer. We've been growing quickly. Our portfolio is about 45 billion now. Our purpose is very simple: is to pay the pensions of our current and future pensioners. And we look to provide financial security to pensioners and excellent kind of customer service. On top of that, we aim to do more. So we look to make purposeful investments. As you can see on the side, we've got more than 9 billion invested in assets like that. So things like social infrastructure, social housing, renewable energy in the UK's universities, and our shareholder base, those who kind of provide capital so we can exist and run the business, are long-term and very supportive and are looking for sort of stable returns as opposed to kind of really high racy returns. You can see kind of on the right-hand side that we've had about nearly a quarter of the bulk annuity market over the last 10 years. You can kind of see all of the key players there, and we also given you a flavour of our clients and of course the various awards we've won. I think probably out of all those, the ones that we're most proud of, though, is the award from the Institute of Customer Service. There's not that many organisations in financial services that have won that award, and it really, I think, reflects kind of the high priority we put on achieving good customer service. So that's what I wanted to say as an intro to PIC.
Thanks very much, Rob. And so let's we've got plenty to get through. So let's maybe dive into the questions and the first theme. And reminder, if you've got a question as we go through, drop it in the chat and we'll pick up. Mark, I'm going to come to you first. Obviously, the pandemic has had a big impact across society. Obviously, we're still kind of living through it to some extent, but perhaps not as bad as things were. Just interested from a bulk annuity provider perspective, what are portfolios looking like coming out of the pandemic? How has it impacted your perspective?
Well, thanks very much, Joe, and welcome everybody. I mean, I think the first point is just to kind of reiterate something that Rob said, is kind of why and how we invest to answer your question fully. The background is we're very much rooted in our purpose, which is to pay our policyholders. So when we're making investments, and I'm talking here about the fixed income piece, which is 95% of the portfolio, we're looking for opportunities where we can provide long, stable cash flows, so we can pay our pensioners over the long term. So it's very much high quality bonds and that long term thing. So there's not been sort of massive changes going through the pandemic, and there's that long term stable basis we start with. And also coming into the pandemic, we had been slightly defensively positioned. We were concerned that we'd had a very long run expansion, and also that there wasn't much value looking on a historical basis in where credit spreads were. So we'd been de-risking for a couple of years, and as a couple of examples, we'd sold down our BBB- bonds, and for those non-experts, that's the sort of still very safe and secure, but they are the lowest risk bonds within investment grades. And various sectors we've been getting out, or reducing our exposure. So we've reduced our exposure to, say, the auto sectors, which is a reasonably cyclical sector. And about 3 years ago, we completely sold out of department stores in the US. So if I talk about the portfolio and kind of what's in it, the key sectors for us are the ones where we can get these long-term stable cash flows. So for us, they're things like utilities, great regulatory support there, and businesses we see very much as long-term, telecom and media, and that's been one of the areas where we've been adding, as you wouldn't be surprised, in the through the crisis. We've got a reasonable exposure to financials as they're a huge part of the economy, but probably lower than we had. And Rob has already mentioned some of the key sectors we invest in, and particularly in our private book, where we're doing direct loans. We are conscious of the fact that these bonds are less liquid, so we're very, very concerned that we want to invest in industries that are going to be there for the future. So we look for sustainable industries. So the biggest industries that we're invested in there, the biggest sectors, are things like education, as Rob has already mentioned, renewables, where we've been adding, and we added to our solar portfolio last year, and housing associations. The other bits and the other changes where we've added a little bit, I suppose, is we've added a little bit to our municipal portfolio in the States. We think there's a very strong and secure cash flows we're getting out of there. And where we've reduced a little bit is from some of our energy intensive names, and we'll pick some of that up as we come on and talk about the we talk about the ESG side on that. So we've looked at those sectors that we think will continue to do well, continue to, and from some of the trends that come out of people staying at home more, and away from those cyclical sectors. So those are probably the biggest shifts.
Is sort of reflecting on what Mark was saying. What you could really hear coming through actually was that the changes were more at the edges rather than fundamental. There weren't any kind of fundamental big shifts in our portfolio. And actually, that shouldn't be a surprise as a bulk annuity writer, because both in the kind of regulatory environment, both in terms of kind of what we're trying to achieve as a business, we're the whole idea of the portfolio is that it's back to the point Mark said about long-term kind of stable cash flows that are kind of really high quality investment grade assets. And we sort of we use this sort of terminology internally, and sometimes with our policyholders we talk about being a weatherproof portfolio. So we don't know exactly where the next challenge, the next economic downturn, or the next kind of market crisis is going to come from. But what we're trying to do is create a portfolio that will be able to weather those challenges, whatever they are. Now, you're always going to have things going on where you need to kind of make changes, but at the core of the portfolio should be able to withstand those challenges kind of regardless. That's how we've approached portfolio construction.
And I think the results speak for themselves. We remain entirely confident we can continue paying the pensions. We have good capital levels, and we've had no defaults in the portfolio.
Thank you both. I mean, it sounds, I think the kind of changes around the edges is really, really interesting. Just pretty much stability through this kind of really turbulent process. I mean, interesting kind of for context, when we look back at the period that defined benefit schemes, presumably much of the client base have had, they're in a really good position now coming out of the pandemic, probably more in surplus and aggregate level than ever before. How does that kind of potential flow of customers feed through to how you think about the future portfolio too?
I mean, that's an interesting point. I mean, we've always, over the last years, we've always taken on, we've taken on new business. I don't think it changes very much how we think about it. I mean, clearly, as interest rates and yields are very, very low, there's an increasing demand for yield as more and more people globally want to save, and they want the same things as we want. So we work very hard in being able to to increase the amount of private debt we have in there, as we think there are more opportunities in there as the public markets get more effectively more and more squeezed. And you've also got central bank, part of policy that's come through as a response to the COVID crisis is central banks buying corporate bonds, buying some of the same names that we would want. So reducing the available supply in those. So we focus, we continue to build up our internal capabilities and issuing and getting involved in opportunities there. And if you look at some of the opportunities that we're seeing coming through, post COVID, government policy is switching, and I think it's worth saying, coming into the crisis, we had incredibly low interest rates, as I think we all know. We'd had a certain amount of QE, we had more QE. I think we're getting to the stage where we're getting to the end of that and what it can really achieve. And we're beginning to see a shift now. It's incredibly cheap for governments to bond, so they're not particularly worried about the quantum of debt they take on. Now that may come back to haunt them in years to come, but that's where they are at the moment. We've seen a shift in the States. We've got a slightly more left-wing government in, and we've got the Democrats there. We've probably got the same happening in Germany. We've got a government that seems very prepared to spend money here as well. So we'll see a shift to more fiscal policy being used as the main tool, and part of that will be used to support parts of the economy that need it, but also there'll be opportunities, things like the levelling up opportunity, and also very importantly, and I think that will happen over a long term, is investment in the green side of the economy. And I think there'll definitely be, we're looking at some of the things that come through there, and looking at those, we're getting involved in more sectors, like income strips. And actually, Rob, you were just up on one of our building sites the other day, and could sort of give a flavour for kind of what those things look like.
Yeah, I mean, if I quickly start off by I think asking about Joe's question and go on to that point. I mean, so we're seeing the same thing, and the number of conversations we're having with the consultants and pension schemes says that they're just better funded than they expected to be at this point in time, which on one level is great. We're kind of we're in this market. We kind of really want this market to be successful. It creates some challenges as well, because we need to find the kind of really good quality assets to support these deals, and we're not willing to compromise on the quality of the assets. But as Mark said, what we've been doing though is looking at kind of expanding and moving into kind of different areas where we think we can find those really kind of long-term kind of stable cash flows, and they are more in the private assets rather than the corporate bond market. To Mark's point, the kind of things that we've been moving into is the kind of build to rent market. So where we'll be the owner of an entire sort of blocks of flats, which will look to rent those assets, so to rent the flats, the apartments out forever, and use the income to kind of pay pensions. And we think that we can find really good assets there, but also at the same time we think we can kind of improve the quality of experience for renters. So the rental market is a one where you can have a fantastic experience, or you can have really quite a poor one. We think we can kind of institutionalize that and make it a really good quality product. We're also looking at things like income strips, where it's in effect it's kind of property lend into the local authority sector, where they're looking to often things like rejuvenate an area of the local authority. They might be looking to provide housing, improved housing for stopping people kind of families staying in kind of bed and breakfasts. And like 2 weeks ago, I was up in Manchester looking at one of our PRS projects. I was up in another part of the North of England, looking with the local council at kind of one of the income strips deals, and you can really kind of just see the sort of the transformative effect that this kind of investing has on the area. Some of these projects are incredibly well thought out, and are genuinely going to make kind of a really meaningful, positive difference to the people that live and work in those areas. And they're also good quality assets. So those are the kind of sort of projects which we're really kind of keen to be involved in. They're hard work. They take a lot of time and a lot of effort, but the reward is there. And I think it's the sort of thing that sort of everyone in our industry would want us to be involved in, from policyholders, thinking about where their money's going, from kind of our shareholders through to employees, through to the regulators. So, not every investment has all those kind of ticks every single box, but the areas we're growing in, we think tick a lot of those boxes.
Thanks, Rob. I'm going to ask you both. I mean, the last point you made, really kind of topical with the letter from the Chancellor and the PM earlier in the year about the investment big bang. We've had the Productive Finance Group report, which is, encouraging funds to think about and institutional investors think about more investment in the liquids and exactly that kind of shovel-ready activity that you were sort of talking about there. I mean, how do you see this kind of playing out? Do you see more opportunities coming from the sort of government support for these kinds of things?
So, I mean, maybe I'll have a first stab at that, and maybe I'll pass over to Mark. I mean, so my view would be I completely understand the drive and the initiative, and to some degree it's what we've been doing for kind of many years and what we're kind of keen to continue doing. So from that perspective, kind of fully supportive, understand where it's coming from, and very kind of keen to be part of it. I think the challenge for us, and I think probably we're not alone in this, and I'd say this across the pension scheme sector and across the insurance sector, is we've not been, it's not been a lack of investing for a kind of a lack of trying. If we see good quality investment opportunities, we will invest in them. So my sort of my request back would be, we need to see more opportunities, and we're kind of very happy to invest them if they're there. There's probably a point around also kind of making sure that the regulatory environment allows us to invest in them, because the regulatory environment is there for very good reason, to protect policyholders, but it's applied on a very granular level, and sometimes that can prevent us from investing in these assets as well.
Rob, you've stolen my thunder on that. That's pretty much what I was going to say. So yeah.
Okay, perfect. Thank you. Be interested now to kind of maybe thinking about, there's quite a lot of talk about inflation, there's quite a lot of talk about other things. When you think about investments that might offer value and protection, given some of these issues and some of those points about added regulatory pressure, how do you think about that?
Well, I come back to sort of the basis of the portfolio. We're invested in principally fixed income instruments. So generally, if you've got more inflation and the cost of things are going up, and companies or projects have a fixed income liability, in aggregate, that's good for them. So it makes them more credit worthy as there's more cash flowing around the system, and then they only have to pay out a fixed amount. However, it's not obviously all like that. I mean, Rob mentioned us, getting involved in a lot more building projects and understanding the risks that are going on there, and what's happening to steel prices if you're building large constructions. It does matter. So we're very conscious about managing those types of risks. And you can see in certain circumstances that some of the inflationary pressure is coming through some supply chain problems. I'm not going to mention the petrol crisis, but that's an example of one I think that we all know of that is incredibly topical. And we just have to be, we have to work really closely. As Rob says, these things are not easy, and it's part of the hard work that we do, understanding those risks when we're getting involved in those sorts of projects. Now, if you look at other bits of the portfolio and other sectors that I've mentioned, I think generally the inflationary side of things is not such a problem for them. Housing associations are allowed to move their rent up in line with RPI. So they get a pass through of that. Yes, they'll have more sort of cost through on maintenance, but we don't think that's a good problem. Utilities, there's always this tension with the regulator with utilities, but they are allowed to compensate for inflation. So for most of what we've got in the portfolio, it's not going to be an issue. And I think going forward, the debate about how transitory inflation is will continue to carry on. But clearly, I don't think we need to get into that. But certainly, for the thoughts about inflation is, yes, we're going to have a bit more of it. And given the way governments are behaving, there's going to be more government debt. There's probably going to be an environment where we end up with slightly higher inflation than when we went into the pre-COVID crisis. It's not going to be, at the moment, nobody thinks it's going to be runaway. but we've got to be conscious of some of the sort of pinch points where we've had issues around supply chains, and that's where the hard work comes in to understand those and make sure we've got all those we understand all those issues. And the last point worth making is when we take on our pension fund liabilities, when we take in a new pension scheme, we carry on the promise that the pension fund made to their members, to their trustees, who become our policy holders. And a really important point for those guys to remember is that we hedge that inflation. So if inflation goes up, we have financial products that will pay us out more to meet and match that inflation. So we're confident we can still make those pension fund payments.
Thanks, Mark. Rob, is there anything you want to add on that? And I guess one thing I'd like to sort of draw your guys' views on, as well as some of the opportunities from regulatory change as well. Having left the European Union, there are various moves around changing some of the requirements on the UK financial services, including potentially European and local level changes to the way Solvency II is thought about and applied.
Yeah, I'm happy to have a go at that. I mean, I suppose just finishing off the last point, I've just really emphasised that last point Mark made. Sort of primary sort of risk for us from an inflation perspective is just the fact that our pension payments are largely inflation linked, and we use inflation swaps, which are a derivative of financial contract, and we sort of fully immunise ourselves from that risk because we just don't have any appetite to kind of face it. I don't think we've got any edge, and I think you probably see that actually from the majority of the bulk annuity market. In terms of turning to your question around Solvency II and the UK leaving the EU, and does that pose an opportunity for us? I think absolutely it does. I think if you sort of take a step back and actually look at what most of the sort of Solvency II regulations are there for, they are there to protect policyholders, and the high level objective of those regulations is a good one, right? So actually, if you look through most of them, they are there for a good reason, and so I don't think we need to absolutely sort of bonfire of the regulations. Where I think for me the issue is that, and focusing on our investment portfolio, rather than the regulations being effectively applied in aggregate to the whole portfolio, they are applied to each individual asset. So I'm just not convinced that leads to the sort of the best outcomes in sort of a combination for our policyholders and for society. So an example might be that we need to make sure that the cash flow match, and we need to make sure that our assets are really kind of high quality. But certain sort of many infrastructure deals are structured such that the debt at outset is kind of BBB or BBB minus, and they're also very long term. Now, and our capital charges increase, very roughly 3 times if it moves to sub-investment grade. So it needs a very small deterioration in credit quality for that asset to become pretty uneconomic for us. And, that would be an example of where I kind of think, well, I think that, they'd still be really good quality assets. I think sort of society and the government would want us to invest in them. But it's, we would really take a hard look at an asset like that and think, is that right for us? Because it, there's almost no, with any downside at all, it's now economic for us and it's a liquid. So that would be an example. I think some of the things around, cash flow matching could just be tweaked such that in aggregate, we've still got a good result and really good policyholder protection, but it gave us a bit more flexibility to be able to support the wider economy.
Thanks very much, Rob. We've got a couple of questions come through. So one of them from Gordon. Gordon, we're going to pick your question up in a couple of minutes with Cleo, but another one from Rob and Mark. Question is, sounds like you're not too worried if rising yields lead to a fall in the market value of your portfolio. Can you expand on how you think about that a little bit?
Can I pick up on that one? Yeah, I mean, we think about ourselves as, I'll say we're cash flow investors. When we take on a new liability from a pension fund, our very clever actuaries tell us down to each year how much cash flow we need to generate. And we go out and buy, this is why we go out and buy a fixed income portfolio with the necessary inflation hedges on top to match those cash flows. Now, if there are different, if as time moves on, the cost of buying those cash flows changes in other words, the value of our portfolio goes up and down, it doesn't actually matter, because we lock into a portfolio where we generate the necessary cash flows on day one. So that's why we're not too worried about the overall value of the portfolio going up or down, because we're matched getting the cash flows in these strong, stable companies that we're talking about. Thanks,
Mark. Okay, so we're going to move into some of the questions in particular about responsible investment. So you need to just bear with me for 2 seconds, because really helpfully the cat has knocked my power cable out of my laptop. So I'm just going to go off screen for a second, and maybe Cleo, if you want to introduce yourself whilst I do that, and I'll be back in less than 2 seconds.
Sure. Hi, everyone. So as Rob introduced, I'm Cleo Fitzsimmons. I joined PIC earlier this year to head up our responsible investment efforts. So quite pleasingly, actually, PIC's been doing a lot on the ESG space as part of its sort of business as usual and day-to-day basis, even before sort of the ESG and big sort of climate change hype, if you want. And that was really pleasing. So I've been kind of brought forward to coordinate our efforts and to enhance them and continue with them. And I think that the pandemic and all this talk that we've been, chatting about so far about the portfolio, it very much touches on sort of ESG. And if we touch on sort of the S of ESG first of all, and then move on to more sort of climate-related topics as Gordon's question and others want to know about. The S has been a big focus of the pandemic, because actually, some of the people impacted the most by COVID were actually those people that are less in a position to absorb that kind of negative impact. And I mean, I'm talking about, if you think of lower paid workers, people living in social housing, the elderly, people, potentially hospitality sector. These are all areas that, people were put on furlough and lost their jobs, and more money needs to flow in those kind of sectors. And actually that ties in so well with the sort of a lot of the assets that we invest in, which we've been talking about, whether that's for investment cases like inflation protection, but actually ties into our purpose of it does create a social impact while also being right and well structured for our portfolios. So I think that the focus on the S, and people have been saying, following the pandemic, has that changed the way you look at an asset on an ESG perspective? And I would say that if anything, it has opened up opportunity for us in many ways, but it hasn't changed much, because it does just tie into our purpose, where we are looking for long-term assets that are going to be around for a long time, that are stable in their cash flows, and that falls into sectors like social housing, like local authorities, like build to rent type of properties. So that's been quite positive for our profile, if you want, although that being said, on a marketing aspect, it hasn't really changed our ethos and the way that we think about investments. What I would say is that, if I can pull a few examples out which bring this to light, I know that Rob, you touched on sort of one of the buildings we've been building out. Sustainability has been very much part of our due diligence from day one. I think coming out of the pandemic, it has allowed us to ask a bit more freely questions about how companies and organizations have been treating things like their tenants or their workers and their workforce. And that's quite telling, the responses you get in terms of the culture of the organizations and how they are also positioning themselves for the long term. And that's actually helped us, the responses we get like that, and coming out with actual live examples of how they've been treating employees through COVID has helped us determine if this is really a company or an organization we want to be partnering with for the next 30, 40, 50 years. So that's been quite positive. We've also made investments that have directly helped people that have been impacted by the pandemic. So things like, for instance, our recent investment in Bromley Council of London, which we have made a circa £100 million investment there, which is directly helping their homelessness crisis, which has spiked given COVID, and it's helping buy 300 homes for temporary accommodation for homeless people. So these are kind of things that actually, they look really good. They're very impactful, but they're actually really good investments for us as well, and fit into the structures that we need, which Mark and Rob have been touching on from the beginning.
Thanks, Cleo. It sounds like you're getting the kind of alignment with the purpose that Mark and Rob talked about earlier through into investments and activities. Just be interested picking up sort of Gordon's question on we'll kind of move the climate and carbon to the next bit of the conversation, but also the kind of influencing the stewardship and how you approach that, and if there are particular things that you think about when you're doing that.
Yeah, sure. So climate and sort of the E of ESG, if you want, has obviously been a big focus for the UK government, for the world, for companies like ours. And I think it has prompted easier conversations to have with the organizations in which we invest, because it makes them a bit more receptive. They now expect these kind of questions. Like Mark and Rob have touched on, we invest both in listed companies, but also in the private markets. And I think the conversation we have with those different types of companies will vary. So for instance, with listed companies, often investment grade, that we'll be investing in, whether that's directly through a bilateral portfolio, whether that will be through our external managers, they're much more used to getting these questions. They have to do certain disclosures, you know, it's not new for them. And a lot of them will be quite advanced in terms of their own climate journey. So I think with those kind of companies and with our managers, the kind of topics and that we engage on, we discuss are maybe broader topics, sort of overall climate targets, overall decarbonization, how they fare against the industry. Do we think targets are ambitious enough? Are management willing to, you know, commit to targets that are not just past their potential term as management of these companies, but actually things that they can influence right away and have that we've seen change. And then in more the private sector, those conversations are quite different, because actually the disclosure isn't always there. The data about where they stand in terms of their carbon position, their carbon footprint, isn't always available. They're actually much more receptive in receiving our guidance in terms of, well, what is it as investors you want to see, working with us and trying to set what we feel are appropriate targets. So I feel like they're a bit more at the beginning of their journey, but also maybe more willing to work with us and find out what it is that we want to know and how they can improve as well. Obviously, that'll be affected a lot by the different industries that we invest and also in the way we invest. So for instance, when we are investing in a build to rent property scheme where we are, you know, majority investors from the beginning, we can influence the design of that property. We want to make sure that, you know, very sustainable, climate friendly designs are input from the beginning, because that will be aligned with our own net zero targets, and also it will be you know, we'll be standing this building for the next 50, 100 years. So as regulation changes and becomes more environmentally friendly, we want to make sure that they're not just aligned with that, but, you know, positioned to be aligned with it in the future. However, then when we're just, say, debt investors alongside a consortium or many other investors, our level of influence that we have is lesser. The topics we discuss with them are a little bit more higher level, because we're conscious that these kind of organizations talk with lots of investors that have their own questions and their own agendas. So we do find a little bit more tension there when speaking with companies and organizations. However, that being said, I think what's quite nice about my side of the industry, if you want to say sort of ESG side, is that there's a lot of collaboration between investors. So in a good way, as in we will collaborate on unifying what we're asking from organizations and companies, what we're asking them to disclose, what kind of data we're asking them from them, and, you know, where priorities are. Because as investors, if we are asking few headline priorities, the same kind of reporting data, it obviously makes it a lot easier for that firm, that organization, to respond with relevant answers to the various investors that be asking questions.
Cleo, do you want to mention our link up with the good economy on in the HA sector?
Yeah, so really good engagement we've had a few years ago, and it's not just climate specific, but it's rather about that sort of standardization of reporting, if you want, is with the housing association sector. So there's been, you know, the this is all private sector investments, and the reporting on various E, S, and G, and specifically focusing on that S side, was quite disaggregated and uncoordinated between them, and the different standards were very different depending on the housing association. So as sort of collaboratively alongside other investors similar to us, we agreed, and there's very sort of amicable and collegiate, if you want, between the housing associations and the investor side, is we agreed on a standard of reporting on sort of ESG and specifically social metrics, which now the majority of housing associations do report on or attempt to report on in a very standardized way. And it makes a comparison between the housing associations a lot easier. It makes the averages of the industry. It helps transparency very much, so that the housing associations know where they stand versus peers. It helps share what best practices as well. So that's obviously like a great step forward for that side of the sector. And hopefully we can agree on sort of similar type of reporting standards, or at least coordination of those between different industries as well.
Thanks, Cleo. I think that point about the S metrics and the challenges there is kind of a real live one. Something that we're looking at with some research that we're doing at the moment around S factors. I'm going to pick your brains separately about how your experience went, and see whether we can compare notes. Another big theme that's been coming up a lot during the course of the last year, 18 months, is net zero. I think you've made your own net zero pledge. I'd be really interested in understanding, the journey to getting there. I think is not necessarily a smooth and easy journey for everybody, and kind of how you're thinking about it and kind of next steps.
Yeah, absolutely. It's definitely not a smooth journey. So we made the net zero commitment earlier this year, but it's certainly not because we hadn't thought about it before. So if you look at our direct peers, you see that many of our direct peers have made that commitment, and some made them quite a bit earlier than we did. I think what I would say about that is we are not the type of firm to say something before we genuinely know that we can attain what we're committing to. So we're a very genuine firm. We like to, we don't say things for marketing purposes. Perhaps we could be disclosing more and sort of, sorry, got muted there. And so we made a commitment earlier this year after having deliberated and discussed it for a long time. We made that commitment, and at the same time as we made the commitment, we've actually joined the Net Zero Asset Owners Alliance, and that was after many discussions with the alliance as well about what our position would be within the alliance. Do they think that in fact we can attain the objectives that we've set? And very pleasingly, through our discussions with the alliance, we got really positive feedback saying, well, you've done so much in the portfolio already since 2019, which is sort of the set base year. You absolutely should be joining us if that's the continuation of the trajectory that you have for the portfolio, because in fact you are more ahead of some of the peers that have signed up, and you're in a good position to be attaining the targets that we would hope that you would set for yourself. So we joined the alliance, we made the commitment. We're really excited about that. My experience from the alliance so far has been really positive. I feel that the alliance is not there to highlight those people that are not attaining their targets and that are sort of disingenuous, but rather it's there to provide support, provide a network, help members work together to achieve, the greater good, if you want, all while being very realistic about what is and is not possible depending on what sector of the industry you're in. So that's been really helpful. And so following sort of the alliance membership, we have been having a lot of discussions internally about what framework we should be using to mold our strategy towards our new trajectory and net zero. And I reviewed a lot of the different frameworks out there, whether it's the Net Zero Alliance framework, the Paris Alignment Benchmark, the various ones, and it comes down to all of them being guidelines, I think, that are promoting the same areas of focus. So whether that is reduction of high intensity areas, that is setting some specific targets of reduction in line with the Paris Agreement, where you would be targeting a 1.5 degrees 1.5 degrees trajectory for the portfolio. It also targets areas where they want to see a certain amount of engagement with companies, and this is stuff that we've already been doing already. So it's not about divesting from companies necessarily and divesting from sectors, because that's not always possible for investors, especially those that have matching adjustment criteria that need to be fulfilled. And it's also about financing the transition. So yes, it's about sort of cleaning up the portfolio, making sure you're in the right companies, but also trying to promote, new innovation, technology, carbon capture, renewables, that kind of thing. So it's quite multifaceted, which is really interesting, and it does actually tie very well into our existing strategy.
And I'll ask you in a second, Cleo, about how you embed that into your strategy. But there's a step before which I think is important, and probably many of our participants will be thinking about for either, or maybe a few will have gone through it. How do you get your board through the journey to signing up, and what are some of the tough questions that you might have to deal with in order to get there?
Like, are we going to make money from it?
And how much is it going to cost?
Yeah, exactly. That's a very natural question. Okay, well, shall I start on this, Cleo? Because
yeah, go ahead.
Just worth saying that before we actually committed to net zero, we were reducing our exposure to fossil fuels in the portfolio. If you look at it on a long-term investment risk, and back to this tying of our purpose and the long-term themes, net zero or not, we could see that some of the some industries are going to become obsolete over a period of time we invest for. So that makes us sort of look up and think, and so we were already doing this for the last 3 years or more. We've been reducing our exposure to coal and oil and sectors like that. Sorry, Cleo, I'll pass back to you.
Not at all. I think it's extremely relevant, and it just kind of shows that although we hadn't made a commitment before, it was very much part of what we did as our purpose, but also meeting our investment objectives. And it's something we think about in a fully integrated fashion, rather than something we just add on because it's what everyone's talking about right now. But back to your question, Joe, about the board. And I mean, I'd like to say actually, it's a shared belief across the firm from the top down, although actions have been from the bottom up, about sort of how much take into consideration climate and ESG makes sense. And the board have always been supportive on this. However, before making commitments like net zero, which influence our strategy hugely, and as I mentioned already, before we make similar commitments, we want to make sure we can attain them, and the board are very much sort of want to be sure that what we're committing to is something we can uphold. They had a lot of questions, so obviously one of them is what's it going to cost the firm? Can we still meet our investment objective, which is to pay our pensioners and then have the cash flows that we need to do this? Is it going to be taking a big pain on the balance sheet at the moment because we're going to disinvest from everything that's carbon intensive, or they want us to paint a bit more of a roadmap, and to get a bit more of a roadmap with sort of high level milestones, targets, and try and quantify a little bit what has been relatively qualitative up to date is very difficult. And though this tangents on a little bit into talking about data, because I don't think you can have a discussion about climate without talking about data. And that's what helps you understand the position you're in now. However, data is hugely imperfect and not widely available. We tend to be making decisions on things like scope 1 and 2 emissions, when really some industries out there, the bulk of their scope is scope 3, which, for instance, like financial services. So how can we be making long-term decisions, which could be potentially very costly on the onset, if we don't have that imperfect data and positioning? So that was very difficult to communicate to the board about where our current position is and how we're going to make decisions when in fact we didn't have all the information there to be able to say that. So it was a mix of getting the data on board, understanding our position, but also having them buy into the long-term trajectory where actually this makes financial sense to make this kind of decisions. It doesn't mean divesting from all of the high intensity areas right away, but the more important aspect is about actually turning in even more on that integration aspect, where now we are scrutinizing companies that we invest in, especially for those longer dated maturities and investments we make, about their exposure to climate risk, and their own commitments to decarbonization and their trajectory towards net zero to ensure that's aligned with ours. So you can still have the exposure to high intensity areas. Yes, you want to dial that down somewhat, but you also want to maintain the risk profile that will allow us to meet our investment objectives, but invest in companies that will also allow us to meet our climate objectives.
Thanks, Cleo. We might come to some of those questions about diversification in a second too. We've got a couple of questions that come through on the platform, so I want to make sure that you get a chance to answer those. So I guess I'll tell you them both at once, to sort of, and then you can approach them together. So I guess one is, is mostly holding corporate bonds. How do you exercise your stewardship? And the other question is a question that comes up a lot, I think: divest or influence. In terms of ESG, does it have any effect if you divest from a listed security if somebody just waiting around the corner to buy it, who maybe not as responsible as a steward?
Yeah, shall I pick up the one on stewardship? Because I think that's it's a very good point. As corporate bondholders, we don't vote. So the obvious way of influence is smaller. Now, I'm going to separate this into two things. I mean, we've talked about the private, but we do, where we say we've got the housing associations, or the renewable energy, the education side. What we're doing when we are lending to company for a long time is we spend quite a lot of time making sure we understand them, and we're basically writing a contract, say, we'll lend you this money for 30 years, you'll pay us in the meantime. And that is a real chance for us to engage with the company. And we talked about, Cleo talked about some of the things we do, say, with housing associations. And I was in our credit committee yesterday, and we were talking about the questionnaire that we have, and new member to the team said it's actually quite a detailed questionnaire. And it was pointed out, yes, but it's pretty well known around the industry. And that's a great example of us engaging, saying, look, if we want to invest with you for the long time, we want to make sure you have thought about these things. So that's our point of maximum leverage, because we can set the terms, or we can decide, in other cases, not to invest if we don't like that. But we still want to engage and keep talking to them about these things. And it's actually been incredibly heartening how most of the companies have responded to that, because they realise these are important things. On the listed side, yes, it is much more difficult. Now, most of our listed corporate bonds are managed by external managers, and our job is to hold those managers' feet to the fire and make sure they are doing this engagement as well. So we ask them, they report to us every, on a regular basis, all the engagement they've done and all the conversations they've had. And for certain areas, we've said, we'll take coal as an example. We said, we want to be out of coal by 2025. But if somebody is moving very rapidly out of coal, we'll give them a bit of flexibility. So we're pushing the engagement through those external managers. It is, we have to hold our hands up and say it is harder to do, when you've got the bond, and in certain circumstances we will sell them, and they will go to different areas. But we're always thinking about our purpose. What is the long-term stability of those cash flows? And if we can't get comfortable for that, we do have to sell them sometimes. And it's better to engage and better to get them to transition. But we're not always going to be able to do that on the on the public markets, unfortunately.
I think what I'd add to that, but Mark makes all the right points there, is that as a bondholder, you actually have a lot of opportunity to engage, because at each reinvestment cycle, you can say, well, we discuss certain, but whether it's the private markets or even the listed markets, of which you could be a very big investor in, bondholders have almost more opportunities to engage, I would say. Maybe not as influence, because divestment sometimes is not as impactful because you're just, like you said, on the secondary markets. If it's a private market, the investment may not even be an option. But the threat of not reinvesting in a company because they haven't met certain targets or engagements or willingness to change, which was already discussed and flagged, is quite a real threat. And even, this is us at PIC speaking as a £50 billion asset owner. I recently had this very similar discussion with people, with very big bond managers like PIMCO, for instance, who said, well, actually our threat is that a company that doesn't meet our ESG credentials or targets may not be considered for not just our sustainability funds, but for actual bond funds, which now have a very high level of sort of ESG criteria in picking. So when a big heavyweight like that says your company may not be in our funds, I think that's a big influence too.
I also think, if I can just jump in and add for a second there, I mean, Cleo kind of spoke earlier about how some of the initiatives in the industry kind of involve sort of more coordination between asset owners and asset managers. And I think that's potentially what we may see happening more in the future. Kind of Cleo spoke about the really big opportunity is when borrowers are coming back to the market. I think the opportunity for the for asset owners and asset managers is to coordinate those actions, and they are far stronger together. And that's where I think you'll kind of, if that happens, which would be an incredibly positive development, you'll start to see the sort of the bond market really kind of exerting its influence on borrowers and kind of demanding change. We're not there yet, but I think it will happen.
Thanks, Rob. I was going to say something very similar. You're not alone, really. There is a huge amount of groundswell amongst other similar investors, whether it's through collective groups that exist already or DVP's Occupational Pension Schemes Council, which is reasonably recently set up to kind of help people share and talk about these issues. I think it is helpful that there's a wider industry push on these topics. I want to just come back to the question about, now mindful of time, to a question about diversified portfolios and how you, with your net zero ambitions, we're in a period of transition with the economy into the new green industrial revolution. There's a lot of opportunities, but how do you kind of get the glide path right and think about the carbon neutrality at the same time? That feels like a hard thing to think about and to implement.
Sure. So I'll start with this, and I think, Mark, you probably have something to add to it. I think, first of all, we are targeting net zero by 2050 throughout the portfolio. Now, I know other investors have come out and said, actually, we're going to target 2040. And that's fine, and that's great. I applaud them. I think for us, 2050 is actually a really important date because that is the date that the majority of our investment universe is also targeting. And that means that when we are selecting companies to invest in, they are also aligned to the same glide path as we are. 2050 is a long time away. So between that, we obviously set certain milestone targets. So for instance, reducing our carbon emission of our portfolio by 50% from 2019 to 2030 is one that has been stated by the ABI, which is our association, and we support those targets. And so it's about then thinking, well, first of all, where are the lower hanging fruit, if you want? How do we have to reposition the structure of our portfolio in those carbon intensive areas? What kind of carbon budget are we setting and how are we spending that to meet our shorter term targets? But then also realizing that a change in regulation will be happening throughout all industries. And we will also need support from the changes in MA regulation to allow us to meet the longer term targets on a structural basis. But like coming back to what I just said about the 2050 target, that is the glide path we are on, and that is the glide path our universe is on. So it's about ensuring that those companies that we're investing on over that longer term and those longer term maturities are also aligned. And it might mean staying invested in a company that is not carbon neutral at the forefront, that it's not the lightest carbon footprint it can, even versus its peers, but it's about through that engagement and understanding the management's willingness to change and to meet set targets that will allow us to determine if they will be on the same glide path as we are. And I think it's maintaining that longer term mindset while maintaining the universe of possible investments that you can have, which is really key to both meeting the investment objectives, but also that net zero objective.
And yeah, I mean, the other thing I would add to that is, we have a series of bonds. The bonds mature. They get paid off. So we're very conscious also of the term that we will lend to certain industries. And one of the things I mentioned, the fact that we've been taking some of our carbon intensity out of the portfolio. We've been particularly focused on the longer end, because clearly, it looks far more likely that the future of the oil industry will be much bleaker in 30 years' time than it is, with oil prices where they are today, for instance. So we're very conscious of the fact that there has to be a transition. What we want to focus on in terms of managing the portfolio and the bonds is having our exposure in 30, 40 years' time to the most polluting, the least likely industries, having that most removed. That's where the biggest transition risk is. But if I can use the energy sector as an example, we're conscious that gas has a role as a transition fuel. It still produces lots of CO2, but it's less bad than coal. So we're out of coal sooner, then we're out of oil, and then we're out of gas next. And that's how we kind of think about managing some of that transition.
Got a couple of minutes left, so I'm going to save some time at the end. But I'm just curious, from an audience perspective, you've been thinking hard about this. Some of them might be in the same position. Are there a couple of takeaways you say, go and think about A, B, and C as a starting point if you're going through it?
To me, I think with my investment hat on, it's about the direction of travel. Clear has made a really good point that a lot of the data around this is uncertain and not sure. You can still do things that are moving in the right direction, even without absolutely having the data to back you up. You probably don't do it all. People can start on this journey because it's clearly moving in the right direction, and you can refine the journey and how you do it as you get more and better data. And
what I'd add to that is, I think what's key is getting everyone involved. So it's not just something a certain portfolio manager is going to do or something the investment team is going to do. I mean, we've talked a lot about sort of our scope 3 emissions here in our investment, but it's also, our own entity emissions, if you want. It's got to be absorbed by the board that have to believe in it. It's got to trickle down to Exco. It's got to be, pushed from the top, but actions have to come from absolutely every business function. It's got to be part of your mindset and really embedded in the entire firm. So it's definitely not something just your head of ESG does or just your portfolio manager, but everyone's got to believe in it and keep that momentum going, even though it's easy sometimes to just push it to, we'll think about it next year or in 5 years' time because 2050 is so far away. It's not that far away, and so much has to happen before then. So mobilize everyone, get everyone motivated and working towards this and thinking about this on an everyday basis. It comes down to the sustainability of the company, what employees are doing on a day-to-day basis, and just how people think. And if it's a part about everybody, how everyone thinks about ESG and climate on an everyday basis, it's going to be a part of what they do on a day-to-day basis, and that's what's going to get us where we need to be.
Thank you very much, Cleo. And I think really good points. Kind of embed it. There's so much of this coming. Only this morning, another report from the Work and Pensions Select Committee, particularly on a climate focus. The regulation, the engagement will keep coming. But we're close to time, so I'm going to wrap us up. I'm going to say really thank you very much to Rob, Mark, and Cleo for some great answers to some tough questions. There's clearly an enormous amount of work going on. If I summarize kind of while I'm here, come through the pandemic robustly, there's been some questions around the edges about adaptations and future opportunities feel like they're bigger than some of the future challenges. Huge amount of thinking going into the kind of ESG elements ahead of COP and beyond with all these regulatory changes. And the other thing that really struck me is I like hearing the purpose right through from the very beginning to the end, how this kind of purpose bleeds through all of the things that you're thinking about. So really thank you very much. Thank you very much to our audience for participating. The session will be available online to download later, and there are future sessions that you can book in for too. So many thanks.